Good afternoon, everyone, and welcome to BioStrategy Partners May Practical Knowledge Series panel. Today we're going to be talking about early stage capital, the fundraising of early stage capital for life sciences companies, and we have an absolutely fantastic panel for you today. And a word about this program. If you're new to Practical Knowledge Series, we are a function of BioStrategy Partners, which is a not-for-profit organization that is designed to accelerate the transfer of technology from academic settings and research universities into the marketplace. Here's a listing of your moderator and panelists, but we'll come back to that. First, a huge thank you as always to our sponsors, MVM Associates, Cesar Ribes Intellectual Property Attorneys, and University Place Associates. And with that, what I'd like to do at this time is turn it over to our moderator, Heather Hunter.
Make sure my speaker is on. Good afternoon, everyone. My name is Heather Hunter. I'm the Vice President of Communications at Venatorx Pharmaceuticals, which is based in Malvern, Pennsylvania, right outside of Philadelphia. We are an anti-infectives company with an in-house discovery engine that's currently has 3 clinical stage assets. We have one that's an intravenous antibiotic that's in phase 3 and is expected to have top-line data at the end of this year. We have an oral antibiotic that's in phase 1, and then an antiviral program that's targeting hepatitis B that is on track to start phase 1 later next month. I've had over 20 years of experience working in a variety of industries, including venture capital, focused on healthcare and technology, as well as commercial real estate, working with both public and private early growth and late stage companies. And my role really has been to implement integrated marketing, communications, and investor relations strategies to foster strategic partnerships and ultimately M&A opportunities at premium valuations. So over the course of my career, I've worked with over 100 companies that has built value probably in excess of about $5 billion. So it's been a fun journey and a pleasure to be here. Mark, why don't I turn it over to you to introduce yourself?
Great, thank you. Good afternoon, everybody. Mark Mitchell is my name. You probably tell from the accent I'm from a little further south than here in Australia, although I'm based in Bucks County, PA at the moment. I was a long time with Tyco International as an operating CFO for a lot of their overseas operations. Some of you may well know the name Tyco from the medical side. Bits of pieces are in Mallinckrodt, Covidien, different areas, but I was always in the fire protection and the security side of the business, ADT, home burglar alarm being the largest one you're probably familiar with. So you're wondering why is a non-life science guy here? I'm not a life science investor, but I invest in life science companies. And so that's the perspective that I'll be bringing today. Most of my time now is spent as an angel investor. We'll talk a little bit more about that. So I invest through Delaware Crossing Investor Group, which is based in Princeton, New Jersey, and Bucks County, PA. But I'm also very actively involved in a number of groups, including Mid-Atlantic Diamond Ventures, Ben Franklin Technology Partners, also help with a number of universities at Temple and Princeton University, providing coaching, guidance, and mentoring in various areas to early stage startups.
Great, thanks. Joe?
Great, thank you, Heather. My name is Joe Hackett, and my background initially was in the finance space. I worked for a number of different regional and super regional banks, ran a couple of private banking groups, and as part of my strategy there, I started an angel investment group, which I continue to run today. And during my tour with the angel group, I increasingly ran into the Ben Franklin Technology Partners as they were hosting and helping to bring into existence early stage technology companies. Most recently, 6 weeks ago, as a matter of fact, I became the South Central Director for Ben Franklin Technology Partners. We cover a 9-county area for the South Central group, but the CNP, Central and Northern Pennsylvania group, which is what South Central is part of, goes from the southeastern border of Lancaster County to Lake Erie. So we cover the 32 counties where there's probably more animals than people in some counties, and we're creating businesses out there focused in the technology space. And So I'm looking forward to joining the panel and answering some of the questions and looking into some of the topics that we're about to discuss. Thank you.
Great, thanks, Joe. And then Rick?
Sure. Hi, everyone. My name is Rick Jones. I'm one of the 3 investment professionals at BioAdvance. We are a seed early Series A venture capital fund. We are a little different than most VC funds in that we actually are closed. That is, we don't have any external investors at this point. We're just recycling money that we've earned over the years. So it's an evergreen fund. We're also a nonprofit because of our origins originally as a state-sponsored group way back in the early 2000s. We do retain kind of a mission orientation to really help out early stage entrepreneurs in the life science space. Other characteristics about us, we're focused on the geography between New York City and Washington, D.C. And we will look at really any sort of life science technology from research tools through to gene therapy, therapeutics, although the majority of our investments are divided into therapeutics and digital health these days. I'll save the rest for later, but looking forward to the conversation.
No, that's great. So for those who are newer to fundraising, there's a lot of terms that get thrown around, angel, seed stage, venture. Since all of you kind of touch upon different areas, perhaps you can just further explain what that means. And let's start with the angel investing, Mark, with you. And for companies that are looking to raise money, what are some of the things that they need to understand in order to move forward with that phase?
Yeah, thanks, Heather. I think a lot of the confusion starts with the term early stage, which is a relative term that throws people off already. But angel investors will likely be the first people that you get money from who you don't know personally, other than grant money and those sort of things. But that's probably the good way to look about it. And the critical thing to know about angel investors is that we are investing our own money. So venture capital will go out and raise a fund, and that then they're somewhat beholden to the people that they've borrowed the money from in order to deliver returns. Angels are different in that aspect. We certainly expect returns, but it's our own money that we're investing, and so sometimes the decision making can seem a little bit odd, but that's really what drives what people do. There are individuals who can invest just on their own, they're quite wealthy, but most of us are relatively normal people, and will form a group to get together to share workload, share experience, share knowledge. And so you'll see a lot of angel groups around. We're investing a little bit of money each, but when we group it together, we can come up with an amount of money that's important for people. And the other important aspect, I would say, is that there's a giving back element to angel investors. So a lot of angels are retired, but I'd say over half of our group are still in active employment. So we're really amateurs by definition, in that we're not doing this as a job. But we're doing it because we have a genuine interest in supporting the local entrepreneurial networks. And so in addition to money, we give a lot of time, a lot of effort, not just to the companies that we invest in, but also the companies that we may not invest in. So let me pause there. I think I've covered most of it.
No, that's great. And Joe, maybe you can kind of segue into the next phase, recognizing that Ben Franklin, you have a specific geographic focus, but maybe even speaking more broadly to Ben Franklin Technology Partners, and where you come into play, with companies as they're fundraising.
Certainly. And so each of the Ben Franklins, there's 4 in Pennsylvania, and they were created to initially help to commercialize a lot of the intellectual property that was being created at Penn State. In our case, there is a Ben Franklin in Pittsburgh, there's a Ben Franklin in Philadelphia, and there's a Ben Franklin in the Lehigh Valley or Poconos. And our group, we work with very early stage companies in helping them to bring a concept and determine if a concept works. While Mark said that they're early, I think that we might even, because we're in a different market, we might even be earlier than the first angels. We might even be in there with friends and family, or maybe just investor money. And typically what we're starting at is maybe as low as $25,000 and sometimes as high as $100,000 in investing to really help germinate an idea. We also are very engaged with helping these companies to move along the process. We have resources because of our connection to Penn State. We have some legal resources that we rely on. We have HR resources that we provide. We have some accounting help. And again, these components are really critical to these early stage companies, because typically it may just be a founder who may be a technical person, may not, and maybe one technical person. So we don't have a company yet. We have an idea that's trying to germinate into that company stage. So we're very early in the process.
No, that's great. And then Rick, yeah, with BioAdvance.
Yeah, so I agree with Mark that the early stage is kind of in the eyes of the beholder. So we consider ourselves early stage, but not as early as Mark and Joe. And for us, I think the difference might be that we are looking for something where there is a concrete product or technology where there has been significant proof of concept that now can enter into a fairly controlled and planned development stage. So in other words, it's past a lot of the early discovery, trying to figure out if something will work, can work, and it's more into the stage of we have something that seems to work. Maybe it might be in tissue culture, it might be in animal models, it might be on a prototype sort of a benchtop basis for a device, but you're on a path to having a fairly controlled development process. So that's where we step in. Our checks tend to be a little bit bigger probably than you'll see with Ben Franklin or our angel group. So depending on the technology, somewhere between 100,000 and $1 million or $1.5 million, the larger checks being for therapeutic projects. Yeah, we also try to be very active in terms of advising and helping people out. We have people who have lots and lots of industry experience around the table, and you can expect us to be significantly active if we're part of an investment.
Great, thank you. So, I guess ultimately for everyone on this call, right, the industries and the target indications might be different, but if there's a way to kind of generalize the answer to this question is outside of needing it, when is a good time to raise money and or start talking to outside investors to bring money in?
Maybe I could start there. But, from our point of view, again, we like to see a significant amount of justification for the approach that's being taken. So this is no longer just an idea on paper. It's no longer something that's being worked out in the lab. Is it or is it not important? In our industries, which again are mainly human life science, we expect a lot of that work to be done with grant money in academic settings or with support from friends and family, and with transition grant money as well, very, very important, like SBIRs, TTRs, and so on. So once there's that sort of some evidence that this particular approach can work, then that's kind of when we would step in.
Yeah, I might just add maybe the broader question of when to start talking. I don't think you can be too soon at all. Obviously, there's a trade-off to time, A lot of our deals I will have spoken to 1, 2, possibly even 3 years earlier and tracked through. And as you build the relationship and the knowledge and the comfort as you have achieved deadlines that we may have spoken about a year ago. So while making formal pitches and requesting dollars, you've got to time that to the right stage that you're at. Starting the conversations and having people aware of what you're doing, I'd say you really can't start too soon.
I have to agree with Mark. One of the biggest challenges that founders have is that a lot of companies, early stage companies, run out of money. And so, if you were to do a timeline, I would say that if you think you need money, you should be looking at your cash burn and your funds flow and those other components. And you should probably be starting at least a year, if not 15 months before you need to have completed that raise, because it's going to take you probably 6 to 9 months to complete the raise, at least in the early stages. And as an example, I mentioned the angel group that I work with. Our group probably looks at between 300 and 400 companies a year. 125 or so of those companies get into the process of being able to present. We actually look at 24 companies a year, and we fund between 4 and 6. So if that gives you any idea of the numbers that you need to, work with in order to get funding, that'll give you a sense of the time frame that you need in order to invest in order to be successfully funded.
Yeah, and I can only say our numbers are very similar. We see 300-400 deals a year, and we make 2 or 3 investments at the end of the day. So it's.
And one of the questions that did come up, and the timing is perfect, is, we've got 3 investing groups on the call now. How does everyone on this call find investors, right? What are the resources? What are the avenues, the events? I realize it's been a virtual world for a good bit as we start to transition into more in-person, sessions. Ultimately, where can they find the right investor for their company?
I guess I'd start by commenting how collaborative the early stage environment is, especially in this region. We all talk regularly, we all discuss deals, and quite logically, because there is no one of us can provide enough money to support the needs of a company. So we have to get together, we have to co-invest in order for that to happen. So the very positive of that is we're constantly talking to each other. And so once you get connected to one person, you've got a very good chance of getting connected to the entire group. But a little more specifically, there are a tremendous number of events designed to bring entrepreneurs and investors together. Most of the universities have some sort of program where they're offering that. A large number of independent groups. I mentioned Mid-Atlantic Diamond Ventures that I'm a part of, Angel Venture Fair, the PACT organization. Ben Franklin is a tremendous supporter of all early stage companies. So there are almost too many events around to try and attend them all, but it is a very active environment.
And Ben Franklin begins to make a lot of those connections through what we call a Techcelerator program. And that's a 10-week program designed to facilitate the evaluation of an idea and whether it's got legs and could become a business. And so that's one of the key ways that we do that. Our group probably runs 8 or 10 of those sessions a year throughout our footprint. So from Lancaster, York, Harrisburg to Erie, Johnstown, State College, Huntington, we run these programs all over that 32 county area that we work in, that we fund. And through those programs, we also have a big idea contest. We work closely with the launch boxes from Penn State. and some of the other colleges and universities in our footprint. Mount Alto just did their Lion's Den program, where it's a Shark Tank version of presentations. I think they had 12 companies that presented there. And so we're trying to get those people who are interested in learning about how a business needs to be established and what all those components are. And we're a year ahead of you're talking to Mark, at least, and probably 2 or 3 years ahead of you're talking to Rick. And so our group in particular is probably one of the earliest touch points for technology-based companies throughout the central and northern footprint for those 32 counties.
I'd like to introduce a question here. We have a great and timely question from Mark. He asks, what are the 3 to 5 most important questions that a company can try to answer or address in an investor pitch? And he also wonders if you might touch on what might be more important in later stage pitching.
A lot of great points in that one. What I'd start by saying is we are going to talk 5 to 10 times before any investment decision is made, and I'm sure the others are similar. So it's a peeling the onion process, really, of starting broad and digging deeper and deeper. But to specifically answer the question, my approach is, number one, what is the problem being solved? Is it a real and significant problem? If you get over that hurdle, the second one would be, does this solution seem feasible? Now, especially in the life science area, it's very early, but the solution has to make sense, and there has to be enough early stage proof that it actually will exist. Third point then is, do I think you've collected the team that is going to be able to deliver that business? And maybe the fourth would be, is there a viable exit available? Is there history of companies being acquired in this space? Are there acquirers out there who are willing to buy out these companies, because that's the only way we get our money back? So they're probably the first 4 questions that come to me. If you pass those hurdles, then we'll go to the next level.
Mark, I think those are 4 great points. And what I would do is I would tie 3 threads through that. And the questions that I typically ask are, why you? And that gets to the team question. Why are you the right group to invest in? And it's really important that you're able to present a very compelling reason for that. Why now? So is there an urgency? Is there a real need for this product? And then the last piece is, who cares? Who is really interested in this solution? Obviously, if you've identified a problem, how are they solving it now? And why would your solution want to replace all of those existing solutions? And so if you can weave those 3 threads through what Mark just said, I think you can really have a compelling pitch that would get you to that next stage that Mark talked about, and that's peeling the onion.
And the only thing I would add is that at some point early in the process, you're going to be asked to justify why you stand out from other approaches. There's almost always some other approach in general, or sometimes very specific to the technology that you're trying to develop. And you need to be aware of what else people are doing, because almost certainly your investor audience will be aware, since they hear so many pitches. And B, you need to have some sort of answer to why you stand out from all the alternatives that are out there.
Maybe I can further explore the question here. So 2 other things maybe we can be a little bit more direct about is competition and then go-to-market strategy. So where did those 2 factors play in a pitch, either very early or later as we're starting to raise venture capital money?
Well, at least from our point of view, we like to see a slide, at least, and even in the earliest pitch deck about that acknowledges that there's been some sort of competitive analysis done and tries to make the case for the advantage over the proposed technology. I mean, we know that it's always going to be sort of slanted towards the technology that's being pitched, but nonetheless, at least that gives us some basis to believe that people have begun to consider that. So I like to see that early.
Mark or Joe, anything to add there?
No, certainly it's critical. If we're talking just about a pitch, remember, we're not doing diligence at the pitch stage. But yeah, there has to be some showing that you've looked into what the competitors are, and it's definitely correct. Yeah, there are competitors, and probably the worst thing you can do is say there are no competitors. That's probably the only way you'll really upset us the most. But yeah, just explaining quite logically what are the key attributes for the customer base, and where do you compare with the alternatives on those particular attributes? That's what's most important.
I don't have anything more to add than what Rick and Mark said.
So Joe, actually, maybe you can touch upon the next part. What about team, right? So you mentioned earlier that Ben Franklin, provides a lot of, let's call it kind of back office operational support, for companies that are starting out with maybe a headcount of one. How important is the team to be representative of full-time employees versus advisors, especially as they are earlier in their kind of maturation period versus later as they're starting to, ask for bigger rounds of funding?
Heather, that's a great question. And typically because we are so early, we are working almost exclusively with the founder and perhaps one other, maybe a co-founder. And many times when that happens, they're both technical. And so they need, in order to have a company, an idea is not a company, and that's really a critical hurdle to get over. Just because you have a great idea does not mean you have a company, does not mean you will get any investment from anybody. And so it's really important for you not only to be very clear about how and what your product does, but when you get to that presentation part, I try to get everybody to convert from being 80% product and 20% business to 20% product and 80% business. It's a big transition for founders, but the team slide in that presentation is really critical, and it's important that not only do you talk about who's on your team, but prospectively identify who you need and why. What that does is it demonstrates to any investor that you really understand how a business works and what it means to be successful. We can't be all things in a business, and it's critical for you to be able to find those key pieces that you're not good at and that you're going to get other people to do. And it's not bad that you outsource that to start with. In fact, it's probably, from an economics perspective, the smartest thing to do, because you can get the highest caliber experience for the lowest dollar amount. You're not paying somebody a full salary and benefits, right? You get them when you need them and you can use them. And so it's really critical for you to demonstrate that you understand how business works by having a really strong team slide.
Yeah, that's a great point, that the team will change over time as the needs of the business change. So very early on, it will be technically focused. Right? If it comes out of a lab, right, it's the people who have done the work that will be leading the company. But the next phase will probably be some sort of approval requirement. And so you need to be transitioning to have the team in place for getting through approvals and dealing with CROs and all of that. You need a different set of skill sets. And then once you have the approval, now you're into a marketing space. How are you going to structure your sales force, compensate it, how you're going to go to market. So depending where you are, knowing what skills you need now and what skills you need in the future, and that's a great point. You can have that through consultants. You don't need to have them hired. And the other thing I'd add was that is where the advisory board becomes most important. What skills do you have from your advisors who can help guide you and help you find the right people at the right times as you move forward?
Yeah, the only thing I might add is that if you're a first-time entrepreneur, just seeing if you can start a business, you might be surprised at how much you can actually learn from people and get really valuable input basically for free. I mean, in this industry, there's a lot of people who know services ranging from IP counsel to just consultants in various disciplines who know that early on companies just don't have money. They're willing to provide some really significant advice with the idea that once you have a relationship and the money comes in, that there'll be an engagement. So don't be afraid to ask for people's advice and input, even if you have no money or very little money. Later on, you might be able to compensate them just with equity, which might be, not worth very much at the time, but in the long run, hopefully be very valuable. So in this industry, I think you can find, you can do a lot with a little, let's put it that way.
Heather, may I add one more thing? Rick just brought up a really important point. One of the things that you might strategically want to do is to reach out to groups that are specifically in your space who may be doing much later stage funding and bring them in, because the first thing you want to do is ask people for advice. You don't want to ask them for money.
Well, it's interesting because there's a question in the queue that asks about how to identify specific advice or expertise. The question specifically says, for example, I have an AI technical solution to revamp biomedical recruiting. Would love to get some advice from investors familiar with the recruiting space. So how do I go about finding those experts? What are some of your suggestions?
Wow, I don't even know if there are investors in recruiting. I guess there are, but that's not our space. But my first reaction to that is don't talk to investors, talk to people who are actually running recruiting companies and see how this might fit into where they see the future of their industry going. You don't have to share the house secrets with them, but you can definitely get an idea of whether this is something that makes sense from their point of view, and B, whether they've heard of other people working in the same space. So that would be my advice.
There are often thought leaders in particular areas, and whether they blog about it or are just known within the industry. So there's usually a handful of people who are considered sort of experts, and if you can get to them to try and get their support, that's probably be my suggestion.
And so that's a great point, Mark. One of the things I would suggest is that if you're not familiar with the Angel Capital Association, that you get familiar with them. They have fantastic tools for entrepreneurs that provide some of those kinds of insights. They keep track of how different angel groups invest, what types of investments they make, and therefore there may be certainly some expertise or at least interest in the space as you're describing here in the recruiting space. That is a super competitive, and from what I've seen, the number of types of opportunities I've seen, there's a lot of competition in that space. Doesn't mean that they've got the right solutions there yet, but I'm just saying that there's a lot of there's certainly a lot of activity in that space.
Yeah, as I just had one more thing as an example, just using this as an example, but of what I said earlier about trying to get information for nothing. In this case, looking at the corporate histories for people like Indeed.com or one of these other up and coming recruiting types of technologies, you can find out who the early investors were, and that will give you a clue about maybe where you should be looking and people you should be contacting. There are also undoubtedly conferences in this space, which will do the same thing, give you an idea just by who's speaking at those conferences, who's attending those conferences, who you should be talking to.
Great. So a question came in about essentially putting together milestones, and I'll maybe more broadly ask the question around structuring deals, right? Structuring the funding round. So obviously phase 1 is a big milestone for a lot of companies, depending on the therapeutic area that they're targeting. How would you best advise companies on this call, and those who will obviously watch this in replay, in terms of how they should approach funding structures, whether it's equity, convertible notes, warrants? How do you typically, and it's a little bit of a multi-pronged question, also address just different milestones as you approach your funding structures? Big question, sorry.
Rick, you take the first 7 and I'll take the next 7.
Yeah,
right.
Look, I think for a lot of first-time entrepreneurs, the thing that is the fundamental issue that maybe they don't get when they're looking for money is there's a difference between something that's a good technology, just interesting scientifically, and something that actually can be developed and add value. And what investors are looking for is basically something where they put in $1 today, it's going to be worth $5 or $10 down the road. And so you have to be able to show that as you move along your development pathway, whatever it is, that you'll reach certain stages where you can legitimately say, look, I started with something that wasn't worth very much, but this is now worth several times what it was. And so when you think about your development pathway in that regard, you want to identify what those discrete steps are. Sort of in therapeutics, there are a number of discrete steps, starting with you validated your target, you have some hits, you have a development candidate, you submit an IND, you have clinical data, you have phase 3 data, you launch, etc. So with every project, there are those kinds of discrete steps where you can go back to your initial investors and say, I've increased the value, and hopefully because it's increased in value, you can actually attract other investors who can see, okay, the next step will add even more value. So just in general, I think that's how you have to conceptualize what investors are looking for.
Yeah, I definitely echo those thoughts. And the approach needs to be, this is the milestone, this is how much I need to get there. Yeah. And then that will determine the raise. I've spoken to too many companies where, well, we want to raise $2 million. Well, right. What for? And it doesn't match. If you lay out your milestones, lay out how much money you need, the different types of investors out there are aligned with that approach, and they know at which point they are. So we invest up to phase 1, but we don't go beyond that. And, we provide this amount of money that gets over this hurdle. So you'll be better aligned with the different investors out there if you're clear in what you're trying to achieve and how much money you need to get there. And then the terms and things tend to fall into place because the investor is used to a certain deal structure for a certain stage and a certain amount of money required.
And so to bring it down to the earliest stage, typically What we recommend to companies that are in this space is that they're either looking for non-dilutive funding, which is grants and other types of funding from those sources, or if you are actually going to go out and raise investor funds, that be focused on a convertible note. And the premise behind doing it that way is that you really haven't established any value for the company yet that you can justify to anybody else. And so what you need to do is you need to be in a position where you can establish that value down the road. You will give this earlier stage investor a discount on that first established value, and that will at least give you a better chance of being able to maintain the shares of your company, so that as you hit the revenue ramp and guys like Mark and Rick are now able to look at your company, or maybe willing to look at your company, that you've gotten to a valuation where you're still going to have a substantive amount of the equity in the company as you go through these later steps, hopefully to a unicorn size organization where in the end you have 5%, but it's still a significant return for you.
I'll jump in with a related question from the audience. Veronica has asked, once you agree to partner and fund a company, what is your level of involvement in their further development, and how does this vary by stage of company?
Maybe I'll take that one. So every single deal is different, especially in the angel community. As I mentioned, we look at all sorts of deals. So Delaware Crossing, about half our deals are life safety. Sorry, I used to have a business called Life Science, and the other half will be apps or all sorts of things. So it really depends on what the company requires and what skill set our members have. As I mentioned, we form as a group because we have different backgrounds and different areas. So if you're in a particular area where one of our members has particular expertise, they will likely get involved as much as the company would like. So it's the company that drives it. We are not actively involved in managing companies. That is not our own. We are, as I mentioned, amateurs. We often have our own full-time jobs. So we're not trying to run the companies. We're there to advise and help as we can. So it depends on what the company requires and what skill sets we have within our membership that can help that. So there are some where we're very actively involved, and some where, quite frankly, we're just stupid money because we've gone in with some other people. So it really does vary.
Yeah, and I think this is another thing where first-time entrepreneurs really have to, they come at it, some come at it with a lot of wisdom, some come at it not knowing what to expect. But look, you have to welcome your investors as partners. They're bringing something to the table that you absolutely need to move your project forward. As much as you need the science or whatever you bring to the table, you need the dollars to actually take that science forward. So, and they should be in alignment with you over the goals. You want to make this project successful and presumably seek some financial reward from that. They want to see the project successful and seek financial rewards as well. So you really have to accept them, look at them as partners. There's frequently expertise that they bring that you simply don't have, contacts with other investors, contacts with contractors, consultants, suppliers, all those things they bring as a value add. So in terms of control, there will be some sharing of control that you don't expect your investors to approve every time you buy printer paper, but there'll be some things that you'll have to seek their approval on before you can move ahead. But that's to be expected as part of just simply good financial management. So I think if you you look at your investors as value-added partners, that you'll get off to a good start in terms of the relationship.
I think Rick and Mark both brought up great points. I think that when you're looking at accepting an investment from some investor, they need to bring more than just money. And you need to know what it is that you need, and you need to be looking for that in the investors that you're talking to. And so it's really important. Connections are enormous in all of the investments that we do. It's who you know and who can you bring to the table to help move a certain circumstance forward. And so it's really important that you communicate both efficiently and effectively with your investors. I mean, you have a fiduciary responsibility once you accept outside money to provide them with information and context for their investment. And so it's really valuable to you to make sure that you just don't accept money because it's available, because you don't want to have the wrong type of investor with expectations that are significantly different than yours involved, or it's going to be unhappy for both of you.
Yeah, and I think to further on that, having come from the venture capital side, Veronica, specifically the way you ask the question, you ask once you agree to partner, then what's their level of involvement? And I think just to kind of capture what was said, the level of involvement should be understood, I think, well ahead of agreeing and or accepting the money. The support from investors can range from, the networking to truly operational support. And so that, I think, should definitely be part of the earlier conversations, understanding what that could look like before you actually, agree and or want a specific investor to invest in your company. So, shifting gears from deal structures and the like, in general, where have you seen the current funding environment evolving? Let's maybe keep it specific to the last 12 to 15 months around COVID, but just in general, have you seen specific areas either kind of expand or shrink, based on deal flow that you're seeing?
In the early stage side, we have seen many more companies pivoting to accommodate the needs of the COVID circumstances. We've had a number of companies that I've seen, believe it or not, in the distillery space wind up creating hand sanitizer. And I mean, it's really interesting to watch companies philosophically decide that they're going to do something because it's meaningful and necessary, because we know that alcohol is meaningful and necessary, right? So, but they've taken those steps to make pivots. There have been an extraordinary number of new LLCs that have been created in the U.S. over the last 12 months, and so there are a lot of businesses starting. It's a matter of what types of businesses they're in. We are seeing growth in our Techcelerator programs. We're actually increasing the numbers that we're accepting. And so there are many more opportunities out there right now. And so I think that there's certainly investment opportunities. We're seeing it. We just had our latest round that we went through our second stage in, and we had as many companies as we've ever had in a round in this most recent round. So there certainly is opportunity out there.
Yeah, I would say on the venture side, it's kind of a tale of two cities. It's the best of times and the worst of times, and it's interesting in how that might impact your funding strategy. On the best of times side, there's more money than ever that's available, and you've probably seen just extraordinary levels of investment going into huge Series A's, and of course all the activity in SPACs and so on. There's just an enormous amount of money that's flowing into the space. On the worst of times, the number of deals that is being done, particularly on the Series A early stage deals, is actually not going up all that much. The dynamic is that the deals that are getting done tend to be much bigger than they have been historically. There's a few more Series A, but what the result of these kind of two trends is that there's actually a kind of dearth of funds that are making smaller Series A kinds of investments. These big funds that are being raised oftentimes are so big that they have to write big checks in order to have any chance of deploying their money over the lifetime of the fund. So finding a fund that's willing to do a smaller Series A, like BioAdvance, is sort of the position we find ourselves in. Sometimes we have trouble finding deals where, you know, it's in our sweet spot of the $10 to $15 million Series A, because companies are raising such huge rounds. So in terms of strategy, you know, for those of you who are kind of making it through to that stage where you're looking at real venture capital investment, you might think about different business plans. One business plan would be, you know, a plan that would accommodate a $20 to $40 million Series A, take you maybe, you know, into the clinic, where as before you might have been thinking about something much sooner than that, and you might have to have a sort of plan B for a much smaller raise, because depending on the investor appetite you find out there, you might find that you basically have to present two different value propositions.
Yeah, I'd say three things. Our pipeline is more robust now than it has been for, at least certainly than last year, but even the year before. And I think part of that is just people's lives got turned upside down, and they thought, okay, this is now I'm going to do that business that I've always wanted to do. So we're seeing more activity. The other one, specifically in the life science space, is certainly with the COVID vaccines. I think people are more positive now to the industry in general. It used to have it was a lot of negative thoughts around and price gouging and those sort of things. That has gone away, and I think there's a much more positive attitude now towards, you know, what science can bring to the life safety space. And then specifically on angel investing, a lot of especially local groups, had a restriction, if you like, to only invest locally. And there are a couple of reasons for that. We used to informally say we like to drive to visit our customers. The companies we invest in. I'm seeing a lot of change in that now with Zoom, and we're all so used to sitting on a call now, that on a Zoom screen, that, you know, I think people are questioning that. So it now opens up a lot more opportunities. And so we maybe before only stayed local. Now a company in Texas or California to angel groups might be more interesting. And of course, companies in Israel, companies in Europe, companies in Asia. So I think there is going to be more competition for investment dollars, especially in the US, now that we've gotten used to the fact that you don't need to sit, you know, face to face next to someone necessarily in order to make an investment.
So we have just about 5 minutes left here. At this time, what I'd like to do is to invite our question to again, our audience to again submit questions. You can do that either via the chat, or you could open up your mic and video and ask that way. And also to let our panelists know, our team of excellent panelists and moderator, if there are any sort of words of wisdom they might like to wrap up the day with, now would be a good time to maybe collect those thoughts and share them with the group.
Yeah, I was going to say, you know, is there anything that we have not addressed, you know, on this call that we could kind of leave everyone with, you know, in the last few minutes that we have? Suggestions, tips?
Yeah, one thing that we touched on a little bit was competition, but I want to that a corollary of that is you're all working in a global environment now. Mark was talking about how now funding, even from angels, might go to companies almost anywhere in the world. Your competition is global, but your resources are global. You should be looking not just in Philadelphia and Pennsylvania and the Northeast Corridor, but you should be aware of resources that are, you know, West Coast based, European based, and you should be going after those resources the same way you do after local resources. With Zoom and everything, the barriers are much reduced, and I think it's going to be more and more essential going forward to think of yourself right from the get-go as a global kind of company.
Yeah, I'd just like to echo Joe's point that a lot of presentations I see are like peer review science papers. And so a 20-page presentation is 19 pages around the technology. How it works is important, but it is a relatively small component of the overall thing. We don't invest in ideas, we invest in a business. So make sure you're pitching to an investor that it's not a science paper. Just tell us enough about the technology that we understand it, but you need to explain the entire business of us, right through the team organization, funding, everything about the business is what we will invest in, not just the technology. So just make sure you keep a balanced view when you're presenting to investors.
One of the things that I did not mention that I just wanted to make sure that our participants know is that our group has actually hired an MD who is a serial entrepreneur who works with all of our medical or health related companies. And so there's a unique opportunity that we have in our group to facilitate the development of medically based or related applications.
Another question from the audience, and that is, how likely are you folks to invest in things outside of the area, particularly abroad? And are there any particular barriers that would prevent you from doing so?
I could tell you that we won't invest outside of the 32 counties that we represent and cover. And so we consider Maryland abroad, right? So we're gonna stick to our knitting in those 32 counties. And as long as you're located, as long as your headquarters is there, we certainly would do everything in our power to help facilitate the development of your business.
And we're also geographically focused, greater New York City down to greater Washington, D.C. However, we have co-invested within that area with funds from all over the world, Europe, all over the U.S., Asia, and so on.
Yeah, do your homework as to who you're talking to. Our group stays local, but there are plenty of other angel groups and different investors that will invest. So before you waste your time and their time, understand what their approach is. But there are definitely investors who will invest in operations outside the United States.
That's a great note to end on. Thank you, Heather, for your moderating, for Mark and Rick and Joe. Again, thanks for your contributions and your time. And one final shout out again to our sponsors, MVM, Cesar Ribes, and UPA. And with that, thank you to our audience as well for taking time out of your days to share your experiences, your questions, and listen in. Thank you.